This is our Forex blog for January 12th, 2011. And as always, one of the best ways of trading is using our currency meter and finding the currencies that are strong and buying those versus ones that are weak. You can see around 7 o'clock here, the pound, which also has a weekly trend that's up and a monthly trend that's up. When you trade in the direction of the longer term trend, let's face it, it's a lot easier. Here the yen becomes pretty weak at 7, and the weekly trend shifts down, the monthly trend is down as well, and so you buy the super strong pound and becomes stronger an hour or so later, super strong pound versus the yen. Notice also on the chart the price is hovering and chopping around between a monthly pivot level and one of the fib levels that I draw on here. Here's 7 o'clock right here, and you can see it breaks out of this area. The fib level acted as resistance, and then when it breaks out, it's a great trade because the next support resistance area is up here, and if that gets broken, it's pretty highly likely to go all the way up here to around 50. So that's a very likely 30 pip profit while risking 10 or 15 pips. And you can see the daily, weekly, monthly trends up. The last down move had very little weakness in comparison to the last move up, and so once it breaks out of this narrow range pattern here and goes sideways and then breaks at high, it's pretty safe to go in, and you can see the price went up about 100 pips. Even if you got out of it up here at the next fib level at 64, you made about 40 pips on that trade. Very high probability trade. And two of the things I look at are what are the odds of the trade working. When you trade in the direction of the daily, weekly, monthly trend and you get a breakout of an area that's been hard to go through, it's probably 70% or more likely. The next thing I look at is what's the likely profit target in relation in comparison to the risk. If you're risking 10 pips and you're likely to make 30 and it's got a 70% probability and you're trading in the direction of the longer term trend, which is one of the factors that gives it a 70% probability, you got to pull the trigger. It's a no-brainer. Another one that was strong from 5 to about 8, and the weekly and monthly trend is one of the strongest of all, is the CAD. So you could have also traded this against the yen, buy the strong CAD versus a weak yen, and it wasn't the absolute weakest one at the time, but it did have not very strong a weekly trend. The monthly trend was kind of mixed, so the CAD yen is a good buy around 5. And notice this around 5. It shows up as having the likelihood of going up, and it's kind of chopping around. Our fib level here is acting as support, and there's also a monthly pivot level here. We also have a narrow range breakout. You might have got into this trade right here, and you would have been stopped out with maybe a 10 pip loss, and then you always want to be a little bit careful when buying the next time. When it comes back up here and kind of goes sideways and breaks out, take a shot at it, and the next likely profit target is up here at 36. So you're going to risk 10 pips to maybe make 15, and if it goes through that, you have this fib level here, and you can see this just absolutely took off, and at and above the upper white containment band, this is usually a reversal area. You can see price sometimes can go above it, but it usually comes back down, hits it, comes back down. So when it's at this level, I might have exited half the trade here, put my stop underneath here, and then trailed my stop very closely and got out of the second half up here around 60. That's a very profitable trade. You probably made 40 pips on the second half, and let's just say 30 on the first, with a net profit of about 35 pips. Now, the only downside of this trade is once you're in it and the market's going up there, it doesn't have explosive plus 20 strength, so you got to be a little bit careful. Now, the Australian also was very strong earlier today, but the weekly and monthly trend's down. You can still trade those, but be careful. A lot of times you only have strength that lasts for another hour or two before the weakness returns. You always have to be careful when trading against the longer term trend. But at the time, 1 o'clock, you can see the dollar was weaker than the yen, and the weekly trend had shifted down a few hours before. And so buying the Australian dollar after 1 is a good trade. Now, if the US dollar's weekly and monthly trend were super strong up, it'd be less of a trade. Ideally, you want the weekly monthly trend to be severely weak in one, the weekly monthly trend in the strong one to be super strong. That's not the case. But looking at the chart here, you can see 1 o'clock. Price is kind of hovering around here, and we have a narrow range pattern on here. You are going against the longer term trend, so what that tells you is always anticipate making less money on the trade. So you buy this breakout right here when it breaks out the narrow range pattern and this previous swing high, obviously, because that was the previous 4-hour bar's high. And this is your profit target, about 15 pips up. You can risk 10 pips to make about 15 pips. And it did kind of stall here, so I would have got out of half my trade here, put my stop underneath here, and it came up and stalled again at this fib level. I probably would have got out of it right here. Not the most profitable trade in the world, and it did continue. And anytime you have a trend up that's this strong after a pullback, again, keep in mind the longer term trend's down. So I might not have bought this first pullback, but when it hit, tried to go up, came back down again, didn't make a lower low here, went sideways for over an hour and broke out. It's a pretty decent place to go long again here with your stop underneath here. And it went up to our trading zone and kind of ran out of steam, and a good place to get out. Now notice that last move up had the most intensity of all, which means the trend's very likely to continue. This is our trend explosion system. I may or may not have taken that trade because the weekly monthly trend was down. If the weekly monthly trend was up, you want to take that trade always, because this fib level got broken, and then any resistance area usually becomes support as it gets touched again, and price can't go underneath there. You get in again here, and it went up another 30 pips. So a lot of counter trend activity in the Australian dollar, but very high probability because the Australian was one of the strongest pairs. Another one that became strong from 3 to 5 was the euro. Now from 3 to 5 you can see the dollar was already weak, so you could have bought the euro dollar during that time. Let's look at that chart. Here's 3 o'clock right here. It had just gone over the 5 o'clock previous day's high, and you had a little bit of a pullback here. Again, the weekly monthly trend's down, and we're right near the upper containment band, which usually is where price stalls and reverses. So you may not have wanted to take that trade. Actually, here's 13. The profit target's around 45. It's 30 pips away. So anytime a price breaks above a previous day's high, that's pretty bullish. You can see that on our FX total view. It shows you, let's sort this and look here at the euro dollar. Price is above the previous day's high. Currencies above the previous day's, weeks, or months high are more likely to go up and improves your odds. So why not take that shot? And once the price comes back down and breaks the hourly here, because the weekly monthly trend's down, you would like to sell this. The only downside of that is we have the previous month's low, which is a major support level, right underneath it. That's why one of the first things I say to you before you take a trade, look to see what the next support resistance area is. Use that to estimate your likely profit target. And if the risk versus reward isn't 1.5 to 2, don't take the trade. Now, I probably myself would have taken this trade just because we know how weak the euro dollar is lately. And if it does break this level, it's likely to go all the way down here to the lower containment band. And it has a very real potential of making 75 pips. So let's say you go short right here and it does come down about 20 pips, kind of goes sideways. You had every opportunity to get out of that trade with a small profit. Now, when it breaks back above the previous day's high again, because of the previous strength on the way up, you might give this a shot because there's no resistance all the way up until the upper containment band. We have a fib level up here, 200-day moving average. There's a lot of resistance. Resistance oftentimes acts like a magnet, and traders don't want to get into a trade until it's right near the support or resistance area. So this trade here, while it's lower odds because the weekly and monthly trend's down, if it does work, you have a good chance for a very high profit target. Use those two, the likelihood of the trade working and then the risk versus reward parameters. If you feel the trade is only 40% likely to work or even 50%, it still may be worth taking the trade if your likely profit target's 25, 30 pips. In this case, it's probably 50 pips. If it works, it has a good chance of giving you 50 pips. And once you're in the trade here and you see this incredible strength, on a tick chart, you might get into some scalps and make 10 and 30 pip moves over the next few hours. Scalping is a very easy way of finding 10 to 30 pip moves, even if you only have an hour or two of trading.